Because what we're trying to do at this stage is increase the probability of close. I think a big mistake a lot of founders make is they assume that if you receive an LOI, that the acquisition is going to close. You're, 90% there. But surprisingly, like 60, 70% of these LOIs, they will fall apart for one reason or another. Buyer can get cold feet. They may not have the funds on hand. They may not have acquisition experience. So we're trying to prevent all that.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Andrew Gazdecki, the founder and CEO of Acquire.com. That's the popular marketplace of sellers of SaaS businesses and buyers of SaaS businesses on the smaller side. They're not hiring big investment banks or M&A advisors and bringing a big team in here. It's an online marketplace with lots of tools and a hands-on assistant from the team at Acquire.com for founders of bootstrap SaaS companies to sell their companies for 100,000, 500,000, a million, or closer to 5 or 10 million. The masses of software companies that get to that level and want to explore selling to financial buyers and strategic buyers. There's tens of thousands of buyers on the platform. Andrew talks about what's happening in this corner of the marketplace, this big corner, and the steps that a founder would think through and go through to sell their company on Acquire.com, and how they vet buyers and sellers, and what exactly happens in that sell your company process. It's a great interview, and Andrew is a huge champion of bootstrapped SaaS founders. Hey, Andrew, welcome to the Practical Founders Podcast.
Yeah. What's up, Greg? Thanks so much for having me.
Yeah, we see each other online. You're a bigger presence on LinkedIn and, of course, on Twitter. Got a huge presence, and we've been waving the flag for bootstrappers and my practical, founder range, with some practical funding in there. And you've definitely carried the flag. So it's very nice to spend time with you. Felt like I know you quite a bit already.
Yeah. Likewise. It's been years.
Yeah, right. So let's talk about your business, Acquire.com. And for those that were paying attention a few years ago, was started as MicroAcquire.com and rebranded and so forth here. Let's just start with, what is Acquire.com these days, and what kind of founders and software companies do you help, and who's on the other side of that, that helps buy them?
Yeah. I'll give you the 2-minute version.
Yeah.
Acquire.com is the largest marketplace to buy and sell online profitable businesses. We focus on predominantly bootstrap founders, companies that are generating less than 5 million in revenue.
Yeah.
Perfect fit would be a SaaS company generating a few 100,000 revenue. It's profitable, maybe too small for a traditional investment bank or a traditional
Yes.
advisory firm. And they're looking to sell the business. And we built out a suite of tools that helps, number one, meet a buyer, draft legal documents, safely close with escrow. And yeah, we've helped 1,000 plus founders, over 500 million in closed transactions. And yeah, it's a super fun business run.
Awesome. Well, if you sell a company for $1 billion, you get a big investment bank. My brother plays that game in New York City, in other sectors, not tech. And then if you sell a company for less than $500 million or 100 million or 50 million, there's plenty of focused M&A advisors, investment banks that focus on a certain size and have their business model there. But for such a long time, if you sold something for less than 5 million, it was a do-it-yourself kind of project. There wasn't enough money in there for people to help. But you've built a marketplace of sellers and buyers, and you've automated and simplified a lot of the process and demystified it. And I think you guys help a little bit. There's some personal therapy along the way. It isn't just a
Yeah.
AI chatbot or a do-it-yourself wing it game. You help them. It's pretty valuable to these founders. So
Yeah, 100%. A lot of the founders we work with, they have no idea how an acquisition works. And
of course.
it's a super emotional process where you're selling a business, it's high stakes. If you're successful, it could be millions of dollars or hundreds of thousands of dollars. So we'll assist with everything from initially meeting with buyers, how to negotiate, how to properly structure the deal, giving feedback on what is a good deal and what's a bad deal, giving feedback on buyers, helping increase the probability of close, helping with due diligence, all the way to the finish line, exit.
And how much of that is, let's say, straightforward or templatized or, automated or software powered? And how much support do you give for founders there? I mean, can they call anytime? Or it's really ironic, isn't it, that founders are all over the product, all over their market, all over their business, but they don't have any idea about how to sell it, right? Never,
Yeah, no,
never got
totally.
to
It
the,
depends
yeah.
on the transaction size. So if it's
Okay.
under 100,000, it's going to be automated through the tooling that we built. And if it's
There we go.
over 100,000, you'll be signing an account manager. We'll do an initial kickoff call. We'll help prepare the startups, documents, the P&L. We'll put together a SIM, a confidential information memorandum, everything needed to help get it across the finish line. So you can do that all on your own on Acquire. We have,
Yeah.
a huge buyer pool where, we've simplified just the entire process of meeting that initial buyer, drafting the documents, closing, and everything in between. But we understand that it's a complex process that's sometimes very emotional. So we're there to help if needed.
Yeah, a lot of therapy, I'm sure you're providing there and insight. And it's not just an AI bot that's going to help them sell their company in the right way and have realistic expectations about multiples and exits and all of
Yeah, but
that.
we do have that. We do have an AI bot that'll actually assist, and it's something that we've trained internally, and it'll go
I
over,
can imagine.
what are your thoughts on this offer? Am I priced too high? Stuff like that. And it's actually pretty sharp, and I'm
I bet.
expecting to get better over time too.
Well, you're kind of the volume guy. So, we're hearing less than a million, you let sub $5 million exits, which for the M&A advisors and some founders, investment bank, that's like very small out there. But you're doing more deals than anybody really in the SaaS business, right?
There's a lot of businesses out there. There's a lot
Yeah.
more small businesses than typically larger software companies. Go figure.
Funny we have to say that. There's only so many unicorns. That's why they call them unicorns.
Yeah, there's this whole interesting world in tech where a lot of people just it's not really talked about, but a lot of people are just starting small, profitable lifestyle businesses, which I think is awesome.
Yeah.
And we help those businesses sell a lot more effectively than other companies. And the main reason is you had mentioned it, where there's just not enough there for a typical advisor or
Yeah.
investment bank to get interested. And so that was the need I saw in the market when I started the company. But yeah, we do on average 2 to 3 acquisitions a day.
A day. Yeah. So you have volume and you could train, on you actually have enough volume in certain niches or verticals or spaces that you can start to train and get
Yeah,
some standards out there, and then influence how the sellers think about their own asset that they're selling. And you could probably
yeah,
influence how buyers think about it, right?
yeah. I mean,
Because
that's a
they
big
all
part of
come
our
with
job.
perceptions, but I'm sure you can adjust that.
Yeah, like getting the two parties to agree on evaluation is probably one of the biggest ones. Because what are these assets worth? It's
Yeah.
easy to put a multiple on a SaaS company doing millions of revenue. It's growing, 200% year over year. There's public comps. But when it's, say, slower growth or just lower double digit growth, but it's profitable, how do you value an asset like that? And then we just leverage, across all the deals that we see every month and every year to
Hmm.
give, some direction to the market.
Yeah. If you're in Silicon Valley and you say that, do they assume that it's all the folks that tried to raise VC funding and couldn't, or raise VC funding and failed? And these are let's say, we tried, but it didn't work, the secondhand kind of startups. Is that what people assume? Because I'm sure there's a few of those, but there's tens of thousands of these companies that people are starting and getting into revenue as well. What is the makeup of the kinds of companies you're selling?
I mean, in terms of the Silicon Valley comment, I mean, no, I think it depends on just who you talk to.
Hmm.
I actually meet a lot of, venture-backed founders or even, investors that love these types of businesses.
Yeah.
They're great acquisition targets. It's just a different style of building
Yeah.
a
Yeah.
company.
Yeah. Totally.
And then in terms of like the makeup of, was it the buyers that you asked or the sellers?
Yeah. What kind of sellers is this? Funded companies that did make it aren't worth as much as they thought, or is it the coder who is doing it part time as a
Yeah,
side job, or
it's going to
something
be
else? everything
Yeah,
in
both
between.
of what you just mentioned. It's gonna be really small teams
Hmm.
on the majority of the acquisitions that we do. So typically one person, sometimes we'll see 2 or 3 with small teams.
Yeah.
And then as it gets bigger, we'll see still same thing, 1 founder, 2 founders, and then typically all contractors. We don't see a lot of W-2 acquisitions.
Right.
We have done a ton of transactions like that, and we do see it from time to time, but it's less common.
Yeah.
And then, yeah, we work with a ton of venture-backed businesses as well where, things just aren't working out. They're looking to sell the business to repay investors or, cash on their chips, whatever the issue might be.
Hmm.
The thing about those acquisitions, though, is they're typically harder to find buyers because there's just gonna be a too big of a gap to close in terms of expectations of what the
Hmm.
business is worth compared to maybe their last valuation. And sometimes the businesses just aren't as good because they're not necessarily profitable. They could be burning cash, and in those situations, it's just really hard to find a buyer.
Right. So you mentioned profits. So these are, it's not like a startup idea. I got it in revenue. I'm still fueling it and pumping it with my own, writing checks into the business. These are ones that have gotten a product and a customer base and revenues that are, let's say, relatively stable and relatively profitable. Like there's a little profit in there, proving
Yeah.
the point.
Yeah, some of the margins can be as high as 90%
Oh,
where
wow.
it's almost all profit. It just
Uh,
depends on the business. Some are, break even, some are not generating any revenue at all. Those are harder
yeah.
acquisitions for us to find buyers for because all the buyers that we're working with, they're financial buyers where they're valuing these businesses typically exclusively based on profit. Because the way that the reinvestment works is, they're thinking, how do I get my cash back in 4 or 5 years? So they're gonna, value the business on a multiple based on profits and use the profit to essentially repay themselves back for the acquisition.
Well, there's that P word that startups around the world, there are even bootstrap ones, there people are writing checks into the business. But with financial buyers, they're seeing a cash flow stream to pay back their investment over time. Are there any strategic buyers? Some of the founders in my practical founder peer groups have up and running companies and cash flow and look at acquire.com and, find little companies and products to acquire to have fun with on the side. They're in the space. They have
Yeah.
an asset to play with.
Yeah. All the time. The buyer makeup split's probably gonna be like 70% financial buyers and then 30% strategic buyers.
Hmm.
The thing with strategic buyers from our point of view is those transactions are typically harder to get done if you're looking to sell the business quickly because you
Ah,
need to build those relationships way ahead of time.
yes.
I think it's a box every founder should check. You should make a list of all your
Yeah.
competitors. You should reach out, start
Right.
building that relationship. But sometimes the stars just need to align for those acquisitions to
Yes.
happen. And a lot of the founders we work with, they're looking to move on. They've already built something new. That's actually the most common reason for
Ah.
selling with the founders that
Uh-huh.
we work with. They've already started working on another company. This one's starting to be neglected. So if you're looking to sell the business quickly, your most likely buyer profile is going to be a financial buyer.
Isn't that interesting? And that's very typical on all the founders I know. And I've been through the strategic process myself a few times. And founders on the podcast, the strategics have been in the works for years, right? It's that relationship has been building, right? And if you can get the timing right for the bigger one to buy you for those crazy multiples. But that's interesting. And so if somebody has a profitable business, maybe it's making 100,000 in profit, 10K a month, something like that. You have a product and you've got to ask why would they want to sell it as opposed to continue to let the profits run and pump it up a little bit. Is that one of the biggest questions that sellers have? Why would you sell this if it's so good? Common
It's one of the
trap.
first questions buyers ask for sure,
Yeah.
for good reason.
Yeah.
If there's something wrong with business or if it's super easy to run, why don't you just keep it? But a lot of these founders, again, they've already mentally checked out of the business. Not all the time. Sometimes
Yeah.
it's, scenarios where they've built a great business and they want to cash on their chips.
Yeah.
Like we did an acquisition 2 weeks ago for 4.5 million in cash. The founder of the whole business, so he became a millionaire essentially overnight. This week, we closed an acquisition for $8 million. Actually, just
Okay.
yesterday. Founder was based in Spain and built a great business, and same thing. Just wanted to sell the business, see a liquidity event, and that's awesome. But most of the time, it is a combination of I'm working on something else. I don't have time for this. I'm burnt out. I'm just neglecting the business and it would be better to just move on. I'd like to, see something for what I built.
Hmm.
So,
Yeah.
it's a very personal question. It depends.
Yeah.
But those are some common reasons I see.
Yeah, that's right. Do these financial buyers and the ultimate acquisitions, are they valued as multiples of profit and cash flow like we see in the real world outside of tech? Or are they whatever, two, three, four, one, two, three, four multiples of revenue? How do people
Yeah,
think about that?
it's going to depend on growth rate. So if it's growing super
Ah,
fast, uh, you know, I think over 60, 70, 80, 100% plus,
okay.
you're going to see a revenue multiple. If it's not, let's say growth is around 10, 20%, 30%, that's going to be on a net profit multiple.
Okay. And can you give a range for what those multiples could be? Somebody gets a company to 500,000 in revenue, something like that, in ARR, and says, this isn't my favorite thing. I want to move on, uh, do something else. What is for, can I just throw out like it's a 30% growth rate and maybe it's 10% profit. So a rule of 40 company at 500,000. Is there a range you could say just to give people a little perspective, just to help everybody be more realistic
Yeah.
about
Yeah, totally.
what a financial buyer on the other side would be thinking about?
Yeah, for that business, I would probably value it between 4 to 7 times net
Okay.
profit.
Yeah.
There's a ton of different, uh,
Yeah.
points to that, some nuance.
Yeah.
Like, is the founder heavily involved in business? Has he delegated everything? Is there a high portion of customer concentration? Is churn really high? But if it's low churn, new buyer could easily step into the business. Processes are documented. Interesting market that isn't like clearly labeled like this is going to be disrupted. Yeah, I think 6, 7 times net profit with the financial buyer would be a good acquisition.
Okay. So that means kind of they're growing reasonably and they have proven some profits, not just that 1 month we were profitable. It's looking pretty steady and there's been some discipline in there.
Yeah,
It's a different way to run a software company than most people are aware of, right? To get to
100%.
yeah, that's awesome. So the kinds of buyers you have on the other side, what kind of buyers are there out there? Are there literally private equity firms that buy things that are this small, or is it
Yeah, yeah,
entrepreneurs that want to buy something and play with it, or what kind of thing?
yeah. The 3 buyer pools would obviously be strategic buyers and then financial buyers, which we were just talking about. But the biggest pool is gonna be individual buyers. So think second-time entrepreneurs, executives at other tech companies that wanna step in, a CEO to a company, kinda like the entrepreneurship through acquisition crowd.
Hmm.
Some of these individuals are rolling up different, profitable software companies. Some are building holdcos. We see a wide variety of that, which is really interesting because without a company like Acquire, it's not very obvious who these buyers would be.
Right.
What I mean by that is, you can go to a private equity firm's website and they specifically say, we buy XYZ companies doing XYZ in revenue. But the individual buyers, it's not as obvious who they are or what
Yeah.
they're looking to acquire. And we bring all that together. So you'd see a good mix. You see, interesting strategic buyers in your market. You'll see some private equity firms, and then just a lot of experienced executives or high net worth entrepreneurs. A big mix of all that.
Wow. Which was more surprising for you? You were an entrepreneur and sold your company. We'll talk about that in a minute. And you realized that not much help down here and nobody knows what's going on. Maybe there's an opportunity here. Which surprised you more? The number of companies there are of this size that want to transact a sale, the founders who want to sell, or the number of buyers on the other side who are very interested in this?
I'd say both, to be honest.
Okay.
When I launched Microquire, I had like a business journal that I keep, and before I launched it, I had a blog entry or journal entry that said like, I don't know if this is gonna work, but the website looks really nice. Because it was originally just gonna be a deal flow platform for me where, you can submit your startup, and I was interested to buy a small SaaS company at the time. And then a ton of buyers signed up, and then a ton of
Ah,
sellers signed up.
okay.
So I'd say it would be both. Another tidbit that still surprises me to this day is there's no way to sell multiple startups on Acquire. we have this terrible workaround. And the reason for that is when I originally built the marketplace, I just made it really hard for us to have, multiple account usage because
Mhm.
I didn't think founders had multiple startups. I just, I did
Yeah.
not think of that as,
Yeah.
and it's our most widely, we're working on it now. But we've had, some founders sell like 6, 7, 8 different startups with us.
And they're all going at the same time, and you're kinda got 'em in it's like a portfolio.
Yeah, I mean, I did a podcast yesterday, with this founder. His name was Johan. He had sold one startup on the platform, and I asked him, "Why'd you sell it?" And he's like, "Oh, I had like 7 other startups. I'm building like my own personal holdco of things that I've built." So I didn't see that coming at all.
Yeah, isn't that interesting? And, the world has changed in the last 10 years. The old days in software, it was all hard to be a bootstrapper. It was a long and hard slog, in the corner. But since it's getting easier to make software and go to market, the one man bands and their friends can get things going and moving in the market without a lot of investment. And I talk to folks in India, in Europe, and all over the world, not just in the States, but there's tons of these founders all over the world, like, tens of thousands of them in India building products, of course.
Yeah,
Y
we've done acquisitions in, I believe, 55 different countries now.
Right.
I thought that was surprising too. I didn't
Yeah,
expect that to happen when I originally launched the company, but we see, different startups submitted from literally everywhere on the globe, which is cool.
right. So, I've called this, and I don't know if this is derogatory, but I think there's kind of I would call this corner of the market the flippers who build something and don't wanna go along with it and, attach their identity to it. They build it and they sell it off and they get the cash and do something else, right? And like the repeat, buyers and sellers, and I've had a few on my podcast, that one, Troy Munson sold one of his companies on Acquire.
Yeah.
The where they built something in spare time, learned something from it, build another one in their spare time, sold it, building a bigger one, and they're kind of using one to fuel another, as a form of funding, and they don't expect to go long. They like the
Yeah.
start. They like the fast start, the fast revenue, so forth. Is that the persona that's out there or
Yeah. Yeah. That'd be the 0 to 1 founder, where they just want to build new things. They want to figure out the initial customer. They want to find,
Yeah.
some form of product market fit. And then as soon as it gets to, anything repetitive where you got to be consistent with marketing, consistent with sales, or God forbid, hiring a team.
Yeah, yeah.
Yeah, I mean, tons of entrepreneurs that just have no interest in doing that. That's also a really common reason for selling is, hey, I taking this thing as far as I can go. I have
Yeah.
no interest in scaling the business more, and I want to sell to quote unquote, 1 to 10 person or scaler. So builder and scaler is how we talk about them internally.
Yeah, that makes sense. And, some builders can get at 5 or 10 million ARR and bigger teams and so forth, but they're kind of stretching their scrappy startup approach as long as it'll go and procrastinating the structured, team and so forth to get you over 10 million ARR in B2B SaaS. And, there's a lot of people waiting at that level to with scale CEOs, right, that can
Yeah,
jump in and all that
100%.
private equity tier. Um, let's talk horizontal and vertical. Presumably, these are all pretty interesting niche products, horizontal niches or vertical kind of products. Is vertical very common? Because if you sell something into an industry, does the buyer have to know that industry and be passionate about it?
Not necessarily. We see
Okay.
all sorts of just crazy verticals and niche products and
Yeah.
like there was one software product that we sold, I think about a year and a half ago now, and it removed the background image on an image and it
Mhm.
was making like 1 million in revenue.
Yeah.
We sold a Wix add-on app. This is a podcast I did last week.
Yeah.
It was called Before and After. Basically,
Mhm.
it's like an image slider, like house looks
Mhm.
bad, and then you just slide it over and it looks
Uh-huh.
good. And they
Uh-huh.
were making like 500,000 a year, like
Right.
350,000 of that was profit.
Yeah.
So some people just make these really, really simple software
Features.
products.
Yeah.
Yeah, features. That's what they are. But
Wow.
they make a ton of money. And then in terms of the buyer, it just depends. Like some buyers are just trying to buy and hold. They're just looking at the cash flow. I want to pay 5, times whatever cash flow it's generating. And I'm just going to hold the business, maybe try to grow it modestly. So they don't necessarily need to be an expert in the industry, or they're not necessarily stepping into like a,
Yeah.
heavy sales role in the
Yeah.
business. More or less just kind of maintaining it and doing more of what's been working. But it just depends. Sometimes we see people that, like, we sold a music DJ request app, and the person had extensive experience in the music industry and just kind of had like a passion for that market. So we see that more commonly, but not necessarily like, I'm a funeral home expert and I want this funeral home software because of that.
Yeah, that's interesting. I guess this is a question, maybe we can go through the process of, how founder might sell and check off some of the milestones and checkpoints that you say that you see there. But does the founder have to go with the product and the business? You're selling an asset, not the
Yeah.
company, and
No.
so do they have to go with it because it's all in their head and it's not really a systemized scaled up business yet, a little factory. Is that a more common thing, earnouts and please hangouts?
Yeah. Like, no, you don't have to. You don't have to do anything. You don't have to sell your company, you know.
Yeah, yeah.
But typically, what we will recommend that you have a transition period with the buyer, because
Okay.
the name of the game when you're working with these buyers is de-risking the acquisition.
Yeah.
So is that 1 month or 2 months or 3 months? But we do work with some founders that literally just need to sell it and move on.
Mhm.
I think the key is just being upfront if that's the case.
Okay.
But more typically, what we'll see is a 90-day transition period where the founder is maybe available for 10 or 20 hours a week, and they get really specific about what's going to be done during that time. So,
Mhm.
documenting marketing,
Yeah.
outlining the product infrastructure, introducing me to key customers, stuff like that. But I've seen kind of everything. I've seen founders just say, just buy it as is. Sorry, I'll be
Yeah.
available for by email when I am. The sweet spot is 3 to 6 months of just light transition, and then we have an acquisition closing within the next month where they're going to be coming on to the acquiring company's team with the notion of we're going to be training other people internally to take over the business.
Mhm.
So it just depends. And I think as the acquisitions get bigger as well, that's where you see more of the, we need you to come onto the team, stay
Mm.
in the business for a little bit, make sure everything's, continuing to operate as we think it should. And then the smaller businesses, I think there's really just not much there to warrant like a full-time role.
Right. Well, this is that messy startup zone, right? It's not into the 5 million and 10 million ARR where there's kind of proven and the founder can step back and think the lights don't dim, or problems don't occur. But I mean, do you see businesses in the 100,000, 500,000 ARR where it's well documented? It's let's say a more of a set it and forget it kind of business. It doesn't take the founder, and somebody could look at that and say, we can definitely do that. It's kind of, strange to think of a well-documented, micro startup.
Yeah, I actually did a podcast this morning with a founder that it's more rare for sure.
Yeah,
Because in
mhm,
the early days, you're just focused on growth, making sure the product works, talking with customers. But this founder, he started documenting everything on day one. I think it just
mm,
requires like a very detail oriented personality to have the
yeah,
foresight to do that. Like, typically what we'll see is, the company doesn't have any SOPs. We'll recommend that they start documenting things just to give buyers some view into how to run this thing, because it's just going to help on the valuation and getting buyers interested and, maximizing the final outcome. But yeah, I mean, it's there, but it is less common. I think if you're a buyer and you're listening to this, you're like, "Oh, this looks interesting." I would expect to not see those things.
yeah, uh-huh,
That's gonna be usually the case. And during, the transition period, that's a great time to, work on those things together if they don't exist.
right. So let's talk about a little bit of the buyer side here. What are buyers looking for these days? And of course, how many buyers do you have potentially who've, logged in
500,000.
and said, I'm interested? Okay,
500,000.
500,000. So it's across the board and so forth. But, you say they're mostly financial buyers, so they have some kind of expectation about multiples and, profits and growth rates and so forth. Is there anything else that's pretty common over there that, if you could say, "Buyers, can you get in this swim lane?" you see out there?
Yeah, there's like, 3 buckets I like to think of most buyers in. One is, below 100,000. That's gonna be just an individual buyer looking for something with maybe a little bit of product market fit. Maybe they have a
Mhm.
marketing background. They want to take the product, grow it a little bit, see what they can do from there. But they're essentially buying, a very, very early startup. Maybe that's just
Mhm.
because of the budget,
Mhm.
because, businesses aren't necessarily cheap. So some buyers will actually start small and then work their way up.
Right.
But below 100,000 to about 1 million, and this is net profit. So below 100,000 net profit, 100,000 to 1 million, and then 1 million and above.
Hmm.
In the middle, that's going to be kind of a blend of quote unquote like micro PE firms. So
Mhm.
this could be, merging private equity guys or gals and whole co companies and just roll up efforts, or other just individuals that want to get their hands on a business where there's a lot more going to it.
Mhm.
And then 1 million and above is, going to be the more traditional private equity,
Ah,
strategic buyers, stuff like that. We still see each in each bucket.
yeah.
Like, I heard a really interesting story last week because we had this like acquire live event. So all these buyers flew into San Diego, met with us. It was really cool. But one guy was telling me he acquired a startup for $20,000, and he put this into his existing company's product. It was
Mhm.
like an invoicing tool. And then they recently raised at a $65 million valuation. So he was able to, buy something really cheap and somehow make
Tuck
it
it
work.
in. Yeah. Mhm.
Yeah, I've never heard of a story like that, but to just give you an idea of like the ranges. So I would
Yeah.
consider that maybe like a light strategic
Oh,
buyer,
mhm.
and they're in the smallest category. And then in the middle, we see the same thing, and then on the upper end too.
Well, that's very common for, the upper stages of in private equity where they're buying a platform company and acquiring around it for cheap and tucking it in and
Yeah,
playing the multiple arbitrage game there and filling out the all-in-one solutions. I'm sure you see all kinds of those things here. Let's talk about product. Presumably the code is scrappy, it's early, the products they're not MVPs. Maybe they're not totally fit and finish product market fit. I mean, do people review code and how
yeah.
of course and do they really? Wow.
Yeah, 100%. Like, there's a big thing with, open source libraries. You can have certain open source libraries
Oh yeah.
inside of your code
Yeah.
where if you have the wrong ones, you have to
Yes.
essentially grant
There.
access to all of it. So you
Mhm.
might need to, like, replace some of those. If the code doesn't make any sense and, no one's able to work on it, it's gonna be just difficult to sell that business because the original person who made
Okay.
the program is gonna need to, come along with acquisition. I've seen scenarios where there was one acquisition we did where the founder built a product in a language that he made himself, and that obviously stalled acquisitions. He found a buyer, but he had to go along with the acquisition to essentially integrate the company.
Mhm.
But yeah, code reviews are very common. That can be a point of contention because when do you
I'm
do
sure.
it? How do you do it? You don't want to,
Yeah.
just give someone open access to your entire code base,
Yeah.
until you've actually received the funds. But yeah, that's a common part of due diligence.
This podcast is sponsored by my friends at Cypress Growth Capital. At some point in your growth, you'll know you could grow faster with some outside funding, but selling a part of your company to VCs would change your whole game. And we know that's the most expensive growth capital on the planet. That's why so many practical SaaS founders I know have partnered with Cypress Growth Capital when they hit that predictable growth inflection point. For 15 years, Cypress has provided non-dilutive growth funding to bootstrap SaaS founders, including 6 successful founders I've interviewed here on this podcast. Cypress provides enough patient capital for you to invest in your growth without giving up any of your precious equity. They leverage their entrepreneurial and operational experience to provide savvy strategic guidance to help you grow efficiently and build your valuable software company faster. Go to cypressgrowthcapital.com/practical to learn more and set up a time with Cliff Centel to see if there's a fit. Now back to our program. Okay. So let's go through the process for a founder that says, I've got a $500,000 business. It's profitable. It's time for me to move on. I want to do something else. And getting listed on acquire.com. Presumably the founder can go in and start filling out the forms and start talking to your people. Do they make a pitch deck and put in their financials and get
Yeah.
things organized? Is that the first step?
Yeah, I'll walk you through it. So you sign up on acquire.com. That puts you through this, really slick onboarding flow where we'll ask,
Mhm.
what does the company do? When did you start it? How many employees? What is your trailing 12 months revenue, trailing 12 months profit, last month's revenue, last month's profit? What is your tech stack? Who are your competitors? Probably takes about 5 minutes to go through, but that can be it if that's all you want to do. And we do a ton of acquisitions with just that alone.
Wow,
You can also connect your
amazing.
metrics. So you can connect Stripe or Paddle or, Braintree or Recurly, whoever you're using for billing. So you get this, beautiful real time view into your financial
Mhm.
health of the business. You can also connect Google Analytics to give a view into the search traffic. And then from there, you can upload a P&L. You can upload any supporting documents. Think of like a mini data room.
Yeah.
And then once you hit submit, that will go over to our team. So we're going to
Mhm.
review every single startup that comes into Acquire. We reject about 80% of the businesses that are submitted to us for one reason or another. It can be just not a fit. It can be,
Okay, so you're
revenue
vetting the
heavy
yeah,
vetting. Yep.
the companies that are appearing because you wanna have a quality marketplace for your buyers.
Yeah, exactly. We'll reject a lot of the biggest bucket of that rejection is going to be pre-revenue startups. We do approve them, but it's gotta be really high quality. We have to use the product. We'll click around. We'll see if we can sign up. We won't accept anything that's like a test product or
Yeah.
under construction or wait list or anything like that.
Yes.
Or if we just think it's a scam, like a lot of
Yeah,
drop
yeah, I'm
shipping.
sure.
So we're just trying to keep the marketplace high quality as we, approve or reject startups. But if this is a 500K SaaS business. Everything looks great. It's a profitable company. We'll put it in a holding pattern and then we'll reach out to schedule initial onboarding call. And then on that call, we're just kind of outlining what to expect on Acquire,
Yeah.
give feedback on the listing, give feedback on supporting docs that we think they should include. For example, if they have a P&L, but it's really messy, we'll
Mhm.
actually recast that financial, meaning we'll look at the expenses. And if there's something like a big owner salary, we'll adjust that and include add backs for a potential buyer
Right.
so
Uh-huh.
they can see essentially what is profit going to be if they were to own the business because you're not going to continue paying the original
Right.
owner, stuff like that. We'll actually help put together a sim with them as well. Confidential information memorandum. Huge word. I don't know who made that up. But we'll sit and interview the founder and we'll
Yeah.
record the meeting and we'll transcribe that and put all those questions into a presentation that's designed with the company's branding. And then from there you go
So you'll
live.
make the presentation like an M&A advisor would.
Yeah.
Yeah.
I can't say we do it as good, like,
Yeah.
we're not gonna spend, like, 4 days on each slide or anything like that, but, yeah, we have a full templated process that
Yeah, yeah.
it gets
Awesome.
all the major questions that any
Mhm.
buyer is gonna ask, and we just,
Yeah.
you know, make it look slick, and so, from there, we're gonna market the opportunity. It goes live on Acquire.com. When that happens, of the 500,000 buyers on Acquire, we have their preferences on what they're looking to specifically
Mhm.
acquire. So all buyers that are looking to acquire a SaaS business with over 500,000 revenue in the MarTech space, or it's a funeral home or
Mhm.
something like that, we can get really specific or really broad. So it goes live. All those buyers are notified that the business is live on the marketplace. We'll also promote it on social media. We'll promote it through our mailing list. We have a morning newsletter and a afternoon newsletter that's more of a targeted list where we're continuing to just market the opportunity, drive as much buyer interest as possible. And then from there, the name of the game is, you're in sales, you're selling the business,
Mhm.
meeting with buyers, answering their questions, scheduling meetings, just really being responsive and, answering any concerns or pointing out growth opportunities or sharing your founder introduction video where you're just outlining the opportunity. Why are you selling? Going through the product. Who is it for? Why shouldn't you buy this startup? Just
Mhm.
to kind of
Yeah.
qualify people a bit more. And then from there, you typically start to see, a good amount of buyers that are interested. Maybe some have, described that they're gonna issue an offer. Maybe some are working towards that. And depending on the amount of interest, we'll put a schedule together. Meaning we'll
Mhm.
go back to all the buyers and we'll work with the founders
Mhm.
to create this on their behalf. But we'll say, hey, we want all offers to come in within the next 30 days. If you're interested, please schedule a initial meeting by this date. Maybe it's in 2 weeks. Offers are due in 4 weeks. And the purpose of that is to just set everybody's expectations. Where if there's a good amount of interest, we're able to say, hey, instead of sending an offer now, I want to review them all in 4 weeks.
Yeah.
And that allows you to negotiate against each other
Yeah.
and improve the terms and the final valuation.
Yeah. Yeah.
If everything goes well, the goal is to get multiple offers. There's a
Yeah.
good saying in acquisitions where if you have one buyer, you have no buyers. So we want to keep leverage. We want to be able to get the best price and the best terms. So let's assume we receive three different offers. The acquired team will set up calls with the buyers based on that. We'll typically ask
Oh,
questions,
wow.
how do you plan to finance this acquisition? Do you have a due diligence schedule? Meaning, if we
Yeah.
sign this LOI, what can we expect? What is the plan? What does week one
So
look
those
like?
offers are letters of intent that come forward that are the
Letters of
first,
intent.
yeah.
Yep. And based on that, we'll typically recommend a certain buyer because what we're trying to do at this stage is increase the probability of close. I
Mhm.
think a big mistake a lot of founders make is they assume that if you receive an LOI, that the acquisition is going to close. You're 90% there. But surprisingly, like 60, 70% of these LOIs, they will fall apart for one reason or another. Buyer can get cold feet. They may not have the funds on hand. They may not have acquisition experience. So we're trying to prevent all that. And we're trying to understand,
Or something comes out in due diligence. It's pending,
yeah,
some next review, right?
yeah, 100%. And
Yeah.
so from there, we'll pick a buyer that we have confidence in, and we move into due diligence. Ideally, we have an idea of how long that's going to take, meaning we ask the buyer directly, how long is due diligence going to go with you? Let's assume it's 45 days or 60
Mhm.
days or something like that. We'll help the founder through that process and be available for any questions. We'll do check-ins, and then you get to typically an asset purchase agreement. So between signing the letter of intent and the asset purchase agreement, we'll refer legal counsel over to the founder because
Mhm.
we can't represent them
Yep.
personally. And it's just good practice having someone that isn't incentivized for the
Mhm.
deal to be advising the legal components.
Mhm.
And the APA is kind of the big document. That's the one that's going to have like legal rights to whatever you agree to in the acquisition. The LOI, the letter of intent, the only legally binding part of that is exclusivity. And it's just outlining from a high level what terms that you're going to be agreeing to go into the asset purchase agreement.
I see.
So that's being drafted. You're going through due diligence. As you get towards the end, you both agree the asset purchase agreement looks good. From there, we'll open up a escrow account with a
Yeah.
company called SRS Acquion.
Yeah.
They're kind of like the slicker version of escrow.com, who
Mhm.
we also partner with, but for the larger transactions, we have more of a white glove service.
Mhm.
And then from there, funds are wired into escrow. Buyer and seller give thumbs up. Funds are in escrow. I've received all the assets. And then from there, funds are released and acquisition closes. And we've done our job right. That's when everybody, celebrates and
Yeah.
gets, yeah.
Well, it sounds pretty familiar to I've had different M&A advisors here in that kind of mid-market tier talking about the steps. And yes, there's the SIM and the LOI and the asset purchase agreement and due diligence and back and forth on all of that and getting buyers aligned and getting deadlines. It's pretty similar, would you say? It's just
Yeah. I
yeah,
mean, the kind of the high
yeah.
level concept is like productized M&A,
Yeah.
where we bring that same exact process to every size business that we possibly can.
Right. Yeah. That's awesome. You're doing work in there. You're showing up. You're getting all these buyers together. You're helping them out. There's a lot of therapy involved to make the most of it. You're contacting buyers and sellers in here. How do you make money in this process? Are there fee structures that are different for different tiers?
Yeah, we have two sides that we make money on. So we charge buyers a yearly subscription to access deals,
Hmm.
and we charge sellers between 6 to 8% depending on the deal size. If it's
Yeah.
below a quarter million, it's
Yeah.
going to be 8%. Quarter million to a million is going to be 7%, and then
Yeah.
quarter million, or excuse me, a million and above is going to be 6%. And on the buy side, it's either 400 or 800 bucks to access deals. And there's a funny
Yeah.
story behind this. When I originally launched Microacquire at the time, it was completely free. There was no fees for buyers, no fee for sellers. I was just kind of winging it.
Seeing it. Yeah. Seeing.
Yeah, why not? And I remember there was a specific seller who listed their startup and had like 150 requests from buyers, and he said, "Who do I focus on? This is like too much. Do you know any of these people? Are any of them legit? Who should I stay away from?" And it was just me at the time. I didn't have any employees or anything, and so I didn't have time to like go through all the names. And so I just said, I don't know. Let's try putting up a paywall. And the idea was to filter out non-serious
Yeah,
buyers. If you
tire
don't have
kickers and yeah,
$400 or
look at those.
$800, you shouldn't be looking at $1 million startup. And so that's how we, vet buyers going in to sign NDAs, and it's also a business model on the side too.
Well, let's talk about the buyers and vetting them. There's a lot of tire kickers or competitors out there and people poking around.
Yeah,
But in order to get access to the deal flow, I guess, and to be able to go one step further and get into NDA and a data room and see some confidential stuff, right? You've got to pay, but do you also vet them? Do you verify them in
we
some
do.
way? Yeah.
Yeah, we do. We do two things. Well, number one, if you're a non-paying buyer and you haven't been granted access to a startup's data room, you can't see anything in
Yeah.
private.
Right.
Meaning you don't know who the startup is, you don't see their startup name, the founder's name, any of the
Yeah.
documents. Basically, just like a blind quote unquote teaser.
Yeah.
You can see like 500K SaaS company in the Martech space, but that's about it. You don't know what company it is.
Yeah.
In terms of buyer verification, we'll verify their funds, meaning they could submit proof of funds using a number of different documents. And then we manually verify that as well. So if any of the documents look
Uh,
kind of funky or,
uh-huh.
whatever it may be, we won't approve it. So as a founder, you can see the funds on hand from every buyer that's requesting access.
Uh-huh.
And the second thing we do is we verify everybody's IDs. You can't request startup access if they haven't verified their identity, just so we don't have like individuals that aren't who they say they are and stuff like that. So proof of funds, and then we verify their ID. And one thing I'll also add too, as a founder, you have full control over who sees your data and who doesn't. Sometimes if you work with an investment bank or an advisor, you don't necessarily know who's seeing everything. Typically, it's all under NDA, but this is a process where you specifically have to grant them access after they've signed an NDA. So just signing an NDA isn't enough for them to get access. You have to receive the signed NDA, sign it back in return, and then click approve on them. So before clicking approve, you can go to their profile, you can check out their LinkedIn, you can send them a
Uh-huh.
message, you can look at their proof of funds. So it's everything we do. Because a big part of this process before, like when I sold business apps, my
Yeah.
biggest fear was having my team find out. So I didn't want anyone to know when I was initially selling the company, and I wanted to tell the team when the time was appropriate. So when I initially built this company, privacy was a big component of that. So there's a few checks that we do to make sure that you're only sharing your startup with who you want to share with.
Okay. Well, I would imagine on the sell side, you're screening out and it's fewer than less than 20% of sellers make it through to the process to have quality companies to market. It's probably that or less on the buy side as well. The ones who are quite serious about it versus maybe the wide world that just wants to see what's going on in here and, tire kick over there. Are there some companies that buy multiple? They're there, picking up?
Yeah, yeah. I mean, especially the micro private equity firms.
Mhm.
Some holdcos, some individuals just buying a portfolio of businesses. Yeah, I mean, the number one person, I don't want to say their name, but they've acquired, I think, like 8 different businesses, a pretty good size, from 1 million to a few 100,000. So absolutely. And then some people buy multiple, just like small products
Yeah.
as well. There's some founders that I know, I guess I should say entrepreneurs, where they're slick is they look for products where maybe one marketing channel has stood up and they have experience setting up another one, and they'll, make that happen and then go and resell the business.
Mhm.
So yeah, absolutely.
Yeah. Let's talk about that in between part. I've interviewed 120 plus founders who've on my Practical Founders podcast here. Over 100 of them have sold their businesses, private equity or strategics and variations of those. And almost everybody says due diligence was the worst time, worst part of the process. It dragged on. Not only is it detailed and heavy and it's like another full time job, but there's all the back and forth and the risk that the deal won't close. Is due diligence an equal nightmare at this phase, both in the complexity for founders, and the work for founders, and the chances deals will fall out?
Yeah, I mean, it can be. I think it's going to be less intensive and say, if you have a company that's worth, 10 or $20 million, that's going to
Yeah,
look dramatically different than a company worth 100 or $200,000.
yeah, I get it.
But absolutely, the deals fall through, things pop up. like there's an acquisition I'm helping with this week where the buyer looked at the business's IP and noticed that it wasn't encrypted for something that should be encrypted. So now the seller has to encrypt it and fix that. Otherwise, the deal is going to fall apart. In that scenario, the deal could fall apart.
Yeah.
So we see stuff like that all the time. It's a common part of acquisitions. But in terms of time frame, when I've gone through due diligence, one time, the first time I sold business apps, the process was 30 days, and it
Hmm.
took my entire team full time, heads down, which is fast. That's a very
Yeah. That's a
fast due
speed
diligence
run. Yeah.
process.
Hmm.
So we'll see some flavors of that, 30 days and below, but sometimes if financing is involved, that can go
Hmm.
all the way to sometimes 6 months.
Wow.
One acquisition I'm working with now, this one's been probably the worst I've ever been a part. I hope by the time this episode comes out, it's closed. But they've been a due diligence for, gosh, like 8 months. It's with a company in Japan, and there's just a lot of work back and forth, and
Mm-hmm.
they have bank financing involved as well in another country, and that just adds additional complexity. So I guess what I'm trying to say is, I think for all acquisitions, it's the worst. It's
Yeah.
a hard part, and when you go through it, just kind of prepare to go heads down and get through it as best you can. But yeah, it's not fun.
It's not fun. That's really interesting all over the world and taking so long. Andrew, on Twitter and LinkedIn, you're talking about the nitty gritty, amazing, crazy journey of bootstrappers and being an entrepreneur, things that people don't normally talk about. And I guess you bootstrapped this to start it, but you also got some funding for Acquire
Yeah.
.com. And tell us about how many employees in the business now, and you have some funding in the business, and how you think about that in your own business.
Yeah, definitely. I wish I would have bootstrapped this business. I think it's the way to go. It's a
Hmm.
better, it's a healthier way to build businesses.
Hmm.
I raised funding during ZERP when the terms were really, really good. So, if I could go back, I would.
Zero interest rate.
Zero interest rate phenomenon.
Yeah.
But also marketplaces are very capital intensive. We
Hmm.
also wanted to build a suite of tools to help us transact. And when I raised capital, we were really just a listing platform. You can list your
Yeah.
startup. That was kind of it. We wanted to add legal document creation, being able to close with escrow. So all that just, requires capital, unfortunately.
Hmm.
But yeah, definitely shout out to all the bootstrappers that can do it without capital. It's way to go. My first company I did bootstrap, we grew that to about 10 million in recurring revenue. That was acquired by a private equity firm. In terms of team size, we're lean and mean. We have a team size of about 20. That's just personally how I like to operate. I think you get more done,
Hmm.
ironically, with smaller teams.
Hmm.
And yeah.
That's awesome. Where do you see this going? Or actually, what has changed since you started this business besides adding the full suite of help into the marketplace there? You used to be called microacquire.com,
Yeah.
and I still have to correct myself because we saw you with that for so long. Are you less micro now? Are you drifting up to a little bit bigger tiers and doing a little bit higher touch up there? And what other things have changed or changing?
Yeah, I mean, when I think of microquire, it was very self-service. It was, essentially just a very simple listing platform. Kind of like my journal entry. It looked good, but it wasn't very functional. It was kind of like a mini community.
Hmm.
Since then, the big two pieces are tools to actually transact.
Mm.
Because when you sell a company, you don't want to just
Oh my gosh.
transfer all the assets and, hey, I hope you hold up your end of the bargain and wire me funds. So utilizing escrow services, we have a really cool letter of intent builder where you can customize all the
Oh,
terms from
nice.
earnouts to holdbacks to seller financing. We also help with the asset purchase agreement generation.
Hmm.
So really building like a true productized transaction platform for M&A.
Hmm.
And the second big part is the hands-on advisory support.
Yeah.
Because again, as founders, we're just not really taught or educated on how to sell a company. I think there's a lot more of this out now, which is great.
Yeah.
But when I started the company, there was maybe like 2 books on acquisitions. The education was kind of thin, and it was a black box. So just providing that hands-on support and the tools to get deals done.
Awesome. Where do you think AI is going to play in this? AI based startups, AI in your business. What are you seeing that's starting to happen with AI first products that are, starting to be experimented with out there? And maybe put on your platform?
I think it's too early to really tell,
Yeah.
but it's absolutely gonna have, an impact 100%. The
Yeah.
biggest one that we've seen so far is almost every SaaS company is an AI company, and every AI company is a SaaS company. I think if you don't have an AI strategy at this point in software,
Hmm.
you may be falling behind. I think
Yeah.
there's
Yeah.
just so many
Yeah.
opportunities in every single industry that literally every I shouldn't say every, like literally every, but every newer
Hmm.
software company, has a pretty compelling AI angle to it. And then in terms of the impact, I think, we're already seeing a little bit in terms of just more companies coming onto the market. I don't know if that's just this year alone or just because, maybe we're growing as a platform, but we have seen a nice influx of just people listing different businesses. And it feels like there could be more software companies created. And we've also seen transactions increase as well in terms of total deal volume and also transaction number. So we're not seeing like any reservation from buyers or any skepticism just yet. But
Yes. And no wait and see on either side. Yeah.
no, no, none at all. Which I think is interesting. I think the biggest part of our business that could be impacted is going to be the smaller deals where maybe there's just a little bit of revenue, and in the past you would kind of build you're buying just that product,
Hmm.
and then today I mean we'll just have to wait and see. But I can see people looking at instead of just buying a product for
Just
10,
make it.
20,
Yeah.
yeah, you can just make it yourself.
Yeah, isn't that interesting? I mean, you're kind of taking advantage of the cost of making software is going down, so people are getting started faster, getting into
Yeah,
revenue, and as it ticks down one more, right, then it's almost like, why wouldn't you just build this yourself,
yeah.
and get it going? So does that mean that it's products are important, but it's really about customers' revenue and growth and, revenue and efficient go-to-market? Is that really what the leverage is,
I think
for
so. I think
Yeah,
maybe you're pointing that out really well. Like, I think what a lot of buyers are looking for is that customer traction. I think,
yeah.
the days of the IP being worth,
Yeah.
100,
Mhm.
200,000 or whatever amount, I think that's going to go away pretty quickly.
Yeah.
But if you have a business, regardless of how it's built and it's, generating revenue and it's profitable and it's growing, I don't think that's going to have as much as an impact as a lot of people are saying on Twitter and LinkedIn. Like the whole SaaS is dead. I don't necessarily buy that at all. There's a big firm called Thomas Bravo, which I
Sure.
know you've heard of.
Yeah.
They're forecasting more software spend to actually accelerate because of AI. So I think that's what I've been seeing. Buyers are, just as active.
That's what I'm
Uh,
seeing.
but I definitely think the next few years are going to be interesting for sure.
It'll be really interesting out there. Well, thanks for all you do to help the bootstrappers and practical founders and the micro entrepreneurs and the early stage SaaS builders out there and the buyers who want to keep these businesses going. I mean, you're probably seeing tens of thousands of business and knowing that that's not even all the software businesses out there. Andrew, how many software businesses do you think that are up in the world that have more than 100,000 in revenue?
That's a great question. Hundreds of thousands? I'd
Hundreds of
say
thousands,
it's in
right.
the hundreds of thousands, if not, millions. I think,
Yeah.
like you said earlier, it's and I think that number is gonna accelerate a lot. If I had to
Yes.
make one bet with us being in
Ah,
the age of AI, the products are getting so much easier to build. You just have so much access in terms of you just open up your phone, you're on Twitter, LinkedIn, that's a perfect marketplace to find customers. So if we're at a few 100,000 now, I think that could definitely increase, to a few million, especially as, job security goes down with AI accelerating into different types of job roles. I can see just being an entrepreneur being a much more appealing career path for people.
yeah. And if you have a go-to-market superpower, you have an audience, you have a community, you have access to buyers and so forth, you could go to acquire.com and find, a product that's up and running that doesn't have your go-to-market superpower and got stuck,
Yeah.
right? And take it to the next level. That's gotta be an amazing story that you guys do over and over again.
Yeah, I always joke and say if I wasn't running Acquire, I'd be trying to buy different software companies off
Yeah,
Acquire because I think that's a great strategy. Yeah, if you have
yeah,
an audience or if you just have any sort of experience with distribution on one different marketing channel, I think it's a very viable way to go.
yeah. Well, Andrew, I ask every founder and expert here on the podcast, what is the advice they would give these bootstrapper practical founders who are getting started, getting on the field, seeing the tiers of, of the success they could build out of their software company? What is the advice you give most often to founders that you think they don't hear very often? I know you give a lot of perspective to bootstrappers out there. What advice do you have for practical founders out there that would be most useful?
If it's for bootstrappers, I would say maybe look at customer acquisition payback period. When I was running business apps, that was like the one metric that I tracked religiously because I wanted to make sure that if I acquired a customer for say $500, I could recoup that cost within 30 days. And I think if you're trying to bootstrap a startup and you don't
Mhm,
have your customer payback below 3 months or something like that, I think it's really,
mhm.
really difficult. So it's kind of a niche piece of advice, but that's something that I watched like a hawk, and it allowed me to aggressively lean back into growth in the business. So that's what I'd recommend if you can do it.
Well, that's where the efficiency comes from, right? To fuel your business. And if you have a great product and you can acquire effectively, it'll grow without consuming a lot of cash. So that's fundamentally what you're saying there is find something that's efficient on the cash side to acquire your customers, pay
100%.
back quickly. So awesome. Really appreciate that. Thanks, Andrew, for being on the Practical Founders podcast today.
Yeah. Thanks for having me, Greg. I appreciate it.
Yeah, thank you. Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.